Good evening, everyone. A warm welcome and happy Women's Day to all the viewers of the webinar being organized by Expert Advisory Committee of the ICI. Myself, CA Parul Gupta, Secretary to Expert Advisory Committee. And today I am joined by Chairman Expert Advisory Committee and our past President of ICI, CA Dr. Devashish Mitra ji, our Vice Chairman of EAC, CA Piyush Chhajar ji, and our team of EAC, including CA Dr. SN Gupta ji, CA Khushbu, and CA Preeti. I welcome you all and thank you. I also welcome our speakers for the day, CA Archana Bhutani ji, CA Sarika Gosai ji, and CA Madhuri Shahpuri ji. Thank you, ma'am, for joining us today and being part of this webinar. Now I invite and request our Vice Chairman EAC to address the participants. Thank you all.
Thank you very much, Parul. A very good evening to all the participants and wish you all a very happy International Women's Day today. And with respected Chairman and the past President, Chairman of the Expert Advisory Committee, CA Dr. Devashish Mitra ji, faculty for the day, speakers, Archana Bhutani ji, Sanjay Singh, moderator, Madhuri ji, the team of EAC, very warm welcome to you. This is the second year in the row wherein the Expert Advisory Committee, generally in the institute, from 12th of Feb, the committee changes. But we have been privileged to continue with this committee under the leadership and chairmanship of CA Devashish Mitra. And again, this year we have made our action plan also of continuing this webinars, which has received an immense response in the last year from the participants also. Apart from this webinars, this year we have also planned to do certain physical events wherein we will be discussing intricacies of the opinions issued by the expert advisory committees, which deals with the various subjects of India's various topics. You may be well aware by now that expert advisory committee is issuing an opinions, and last year we made history under our leadership and chairmanship of CA Mitra ji, wherein we issued more than 54 opinions in a year, which was highest ever in any particular committee year of our Institute of Chartered Accountants of India. With all the support of our co-opted members, technical team, we could achieve it, and will definitely under the similar leadership we will be able to do much better this year also, and we'll try to cross all the barriers which we have set last year. I'm dead sure. I'm sure this has been a very important day. Our team has chosen a very great speakers, all women speakers today, being an International Women's Day. I'm sure a lot of participants would also enjoy listening to them. And very well, 6 opinions have been chosen, which covers different gamuts of India's. I'm sure it would be a quite enlightening session. And my request to all of you, please be attentive to this whole session. And when you have read this opinion, I always say, after listening to them, if you read this opinion, I'm sure your doubts would be more clear and it would be more thoughtful for you. You may have realized what was the thought process which would have gone in this opinion, because generally when an opinion is drafted, a threadbare reading happens from, and it has been drafted by a technical person first, technical advisor, whosoever is. It is read by the committee members, who include technical experts, which are co-opted members as well as central council members, and threadbare reading happens word by word. It has been read, it has been discussed, it has been sorted, and those opinions have been finalized. And when you listen to the discussion today from the experts who are always been part of this expert opinion groups somewhere or others, I'm sure it would be quite enlightening. So thank you very much, everyone, and thank you very much to the faculty and the moderator for joining this evening. Thank you very much. Over to you, Paru. Parul, you are mute. We can't hear you.
Am I audible now?
Yes.
Now I request our Chairman Expert Advisory Committee to give his opening remarks, please.
Right. Good evening to all those who are attending this webinar. The Vice Chairman of the Expert Advisory Committee, CA Piyush Chhajar, and everybody else who are there, You see, S.N. Gupta is the technical director of the institute, Parul Gupta and the others. I am now speaking from Calcutta, and I am now speaking from this ITC Royal Bengal Hotel in Calcutta. Now, why am I here? All the managing committee members of all the branches of the institute, that is 175 branches of the institute, are here today for a 2-day session to know more about the Institute of Chartered Accountants of India. And tomorrow, when we start off, we are going to speak to them what the institute does. And when we speak to them, we will also speak to them about the expert advisory committee. Many of you might be aware of what this committee does, and many of you might be unaware of the same. Let me tell you, see, this committee was formed way back in 1975. And the main activity of this committee is to give opinions on very intricate matters relating to accounts. And the matters sometimes are so intricate that it becomes, you see, it requires the best of minds from all over the country to get together and give an opinion. Over a period of time, we have given more than 1,600 opinions. In the last year, as the vice chairman said, we created a record by giving 54 opinions in 1 year. And all these opinions that we have given are there in 42 volumes of compendium of opinions. And then we have a search engine by which you can, you see, view these opinions in your, in your professional work, when you carry out your professional work. Let me tell you, these compendium of opinions are a treasure house of knowledge. And as the vice chairman was telling all of you, that you see, you know, the discussion and debates that take place before these opinions are issued are so intense and so illuminating that I, as the chairman, at the end of discussion, feel enlightened and feel blessed that I have been a part of this kind of discussions. Today, 6 opinions are being discussed, and being the International Women's Day today, all the 3 speakers are ladies, and it is, you see, it's a pride that ladies. Please note that out 4 lakh members of the institute, about more than 25% are lady members. Out of more than 8 lakh students of the institute, more than 42% of the students are ladies. And at the institute, we are doing everything possible to promote women empowerment and to see more and more ladies, they step forward and participate in the activities of the institute, and also ensure that the flag of the institute is kept flying very high. I have no doubt that you will find the discussions relating to these 6 opinions very, very interesting and enlightening. And at the end of the day, when we complete this program today, you will feel, when you go back home, you will feel a bit more enriched than what you feel at this point of time when the program is on the verge of starting. Let me tell you, in the corridors of the Institute of Chartered Accountants of India, 3 words: excellence, independence, and integrity are very, very important. And we organize this kind of webinars in pursuit of excellence in our professional pursuits. I hope you will find the deliberations very relevant and very interesting, very enjoyable, and do give your feedback about, if you have any suggestions for the betterment of these programs. On behalf of the Expert Advisory Committee, I once again welcome you to this webinar, and I wish you a very, very happy learning. All the very best.
Thank you, sir. Now I would request CA Khushbu Bansal, who is part of our expert advisory committee, to introduce our speakers for the day. Thank you, ma'am. Good evening, everyone. And I wish all the women CAs who are participating in this webinar a very happy International Women's Day. It's really a privilege and honor to introduce our esteemed speakers for today's webinar. Our first panelist is CA Archana Bhatani. Archana ma'am has more than 20 years of experience relating to technical advice on corporate law, accounting, auditing, and other related members. She has been special invitee to Accounting Standards Board. She has been special invitee to erstwhile NACAS and has been a special invitee and co-opted member of Expert Advisory Committee and various other committees of ICAI, such as India's Implementation Committee, Auditing and Assurance Standards Board, etc. Welcome, ma'am, and we thank you for agreeing to be part of this webinar today. Our second panelist for the evening is CA Sarika Gusai. Sarika ma'am has more than 22 years of professional experience relating to technical, research, accounting, auditing, advisory, and ESG projects. Presently, she is heading the technical function of one of the leading firms, ESG and sustainability practice. She is also associated with various educational projects with ICAI and is member of a couple of committees of ESG. She has also co-authored 2 books. We welcome you, ma'am, and we are honored to have you today as one of the panelists. The moderator for today's session, CA Madhuri Shahapure. Madhuri ma'am comes with 19 years of experience in professional services. She has been associated with one of the leading chartered accountants firm. She also represents at international forums such as IFRS Steering Committee and the Methodology and Learning Steering Committee, which deal with complex accounting and auditing matters across the globe and responding to draft standards and interpretations issued by IASB and IAASB. She has also contributed in global accounting publications. Welcome, ma'am. We're grateful to you for joining for today's webinar for moderating this session. I'm sure that we all very curious to listen to our speakers who are experts in accounting. So let's begin the session. Over to you, Madhuri, ma'am. Thank you.
Thank you very much. And I will just share my screen and then we can start off. I hope the screen is visible, if you can confirm that.
Yes, ma'am.
All right, perfect. Thank you very much, everyone. And I'm really thankful to the EAC committee as well as Mr. Mitra and Mr. Chajid for inviting us and giving us this opportunity to have this conversation today. I'm sure while the expectations from us are quite high, I have 2 fantastic speakers with me today. Both Archana and Sarika are absolutely used to and very often do speak to our profession about difficult and complex subjects. So I'm sure they'll make all those complex issues that we spoke about seem a lot more easier once they kind of have taken us through those topics. With that, let me start off. The committee has chosen 6 topics for us to have a discussion on today. While I hope that we're able to complete as many as we can, we'll see how much of deliberation is required in understanding some of these complex matters. All right. With that, I will move on to the first topic of the day. It's a very interesting one, and I think most of us would have come across similar issues in our audits as well. This is on presentation in the financial statements, particularly presentation of standby, stoppage, and allied costs incurred during a force majeure event in a project in the statement of profit or loss. To give you a little bit of background of the case, it's a large corporate in the business of exploration and production of oil and gas outside of India. Essentially, it operates through a huge network, either directly or through its subsidiaries, associates, and joint ventures. We're talking about a particular project, in this case, Project A, in which the company has a 16% participating interest. It's a joint operation. It holds 10% through a wholly owned subsidiary, X, and another 6% through another subsidiary, Y, in which the company has a 60% holding. Now, the project itself is under development. So the development activities are being undertaken by an operator under the joint operating agreement. This joint operator essentially provides an expenditure statement to all the participants called the joint interest billing. So company X and company Y recognize their respective expenditures based on the JIB that they receive on a periodic basis and capitalize the costs accordingly. The company also had a borrowing. So when it made its 10% of investment, there was an external borrowing that was availed by the company. And since these were directly associated borrowing costs, they were capitalizing these costs on the qualifying assets of Project A because it's under development. Now, there was a force majeure event while this project was underway, and the entire project had to be suspended during the year 21-22. The operator, essentially due to security concerns at the project site, had to shut down the operations for that period. And during that time, according to the standard, the capitalization of borrowing costs also was suspended. Now, there were some additional costs incurred. One may kind of assume that, okay, if everything was suspended, then what kind of costs are being incurred? It's the nature of the business, I suppose, which is the reason why there were certain incremental expenditure incurred for the project, even though it was suspended. Two kinds, essentially. One is stoppage costs, mainly the cost of maintaining a reduced team there at the site, whatever is the cost for compensation, demobilization, etc. And secondly, standby and support costs that are incurred to ensure that the assets are preserved. They are in a condition that whenever the suspension is taken off, the assets can be used and they retain the quality and the condition such that they can immediately be deployed for the project and make it operational. So those are the standby and support costs. Now, company X and Y, how did they treat these additional expenditure? This additional expenditure was charged off in the profit and loss. Essentially, they said that this is something that I incurred as a part of my normal operations. It's force majeure clause which was invoked, but that doesn't mean that it is something unusual. I will continue to charge them off because they're not adding to the assets of the company. Also, considering the materiality of the expenses incurred, they made a separate disclosure, a separate line item under expenses itself to present these expenses. In the consol accounts, again, because there was a line-by-line consolidation done by the holding company, these got included as a separate line item in other expenses. So essentially, the company did not disclose either this or borrowing costs as exceptional items. The company's rationale for this is force majeure is a very common contractual term. And in the business that they are in, they are vulnerable to geopolitical risks. They are vulnerable to different kinds of risks in different parts of the world. And it's not as unusual. And again, when it comes to borrowing costs, simply because the reason why the suspension happened was unusual. In this case, the terror attacks, which raised security concerns, etc. That by itself does not make borrowing costs as exceptional. And so they are convinced that owing to materiality, as long as there is a separate disclosure, that should be sufficient and they don't have to really disclose it as exceptional item. On the other side, it was the auditor's perspective that it is both the incidence and the materiality of the expenses that were incurred, which is very unusual. Force majeure is not as common as the company would want us to believe. And so it would be more appropriate for them to disclose this as exceptional item. And therefore, the profit and loss should be disclosed, presented both before and after exceptional item. This was their expectation. Now, in light of this situation, the query that was asked was A, whether disclosure as a separate line item as done by the company is okay or not, or should that be exceptional item? And again, borrowing costs, during the suspended period, should I continue to disclose them as finance cost? Or again, should this also be presented as exceptional items in the profit and loss statement. That's the query we have, and I will call on Archana now to discuss the nuances of this query. Archana, over to you.
Thank you, Madhuri. Thank you, first of all, for summarizing the fact pattern so well. But before I move on to the technical bit, let me just wish everyone a very happy Women's Day and a very happy or auspicious Mahashivratri. And I think with the panelists, with Sarika and Madhuri, we've had wonderful interactions, even off the meetings or whatever. But it's been a pleasure interacting with both of you, and I wish you both a very, very successful journey ahead, and wish all the participants also a very, very happy Women's Day. Starting with this particular topic, I think I'm just going to start with a caveat, which is what even the chairman started with, that these are in the specific facts and circumstances of a case. So please, when you do use this, focus more on the concept rather than on the outcome, because in your particular fact pattern, it could be different. We are dealing with how to classify certain expenses during force majeure. If, let's say, as we will discuss the decision of the opinion of the EAC, let's say if they do say it is exceptional or not exceptional, in your case, the answer for the same item can be different depending upon the facts and circumstances the company operates in. Now, before we even get on to what the outcome is, let's just also understand what are some of the considerations or guidance in the gap that we need to apply, and what is the intention behind that guidance. So when you look at the disclosure, the first bit comes from Schedule 3. Okay, the Schedule 3 says that if there is an exceptional item, recognize it separately. Okay, Schedule 3 also gives you certain expenses which have to be specifically disclosed on the face of the profit and loss account, and that includes finance, income, or cost. So let me put it like this: as far as Schedule 3 is concerned, there is a requirement to show finance cost separately. There is a separate line item for exceptional expenses, but it does not. Schedule 3 does not give you any definition of exceptional item. It does not mandate any circumstances in which you have to necessarily show something as exceptional. It just says if there is something which is so-called exceptional, you please disclose it separately. So that's as far as Schedule 3 is concerned. Now, how do we identify whether an item is exceptional or not? So let's move to the gap. The gap also really doesn't use the term exceptional anywhere, and we understand it more by the guidance which is given in the standard. So if you look at Ind AS 1, there are 3 or 4 paragraphs I would want you to refer to. One is para 82, and I read 82 and 85 together. And then there is para 97 and 98, and I read the two together. Now, what do para 82 and 85? I'm not going to repeat it verbatim, but if you see para 82 and 85 together, effectively they are saying these are some of the line items we necessarily want. Unlike Schedule 3, it doesn't give you a form. It doesn't say X item has to come first and then Y or whatever. It just says these are some of the items which you should show on the face of the income statement. And then it leaves something to the judgment of the company, wherein it says that if you've got something material, something which requires to be shown in a disaggregated manner or separately, then you can do it. So here I'll read it out to you. Para 85 says an entity shall present additional line items, including by disaggregating. Disaggregating means you can pull out a particular item from another. Let's say if I believe within employee benefit, I want to show something more or whatever. So an entity shall present additional line items, headings, and subtotals in the statement of P&L when such presentation is relevant to understanding of the entity's financial performance. So that's one. Now let's see, what does 97 and 98 deal with? 97 says when items of income and expenses are material, disclose them separately, the nature and amount. And then 98 gives you certain example. Quite often, there is discussion about how do 97 and 85 correlate. 97 talks about showing material items separately. 85 is also saying if something is required for an understanding of the entity's financial performance, please show it separately. So how do the two interact? The way I see it is that 97, 98, when you read together, if you look at some of the examples in para 98, they refer to write down of inventory, they refer to restructuring activities, litigation. So by common parlance, we call what the items in para 98 to be exceptional item, right? Because we're saying these are not expected to be recurring. The standard doesn't, like I said, define this, but if you look at the nature of those items, these are usually which are non-recurring. And this is what I think Madhuri also referred to incidents, in terms of frequency, you look at materiality. So 97, 98, if you ask me, I would read it together and look at it like that. In 82, 85, I would look at it something which is not even exceptional, but in the ordinary course, it is still material for an understanding. I would look at disaggregation criteria applying 82 and 85. Why am I emphasizing so much? Okay. And I'm sure EAC office would appreciate. Recently, we had a lot of discussion around some outreach on an IFRIC in terms of segment disclosures. And that also refers to 97, 98. So it becomes very important. How do we read 97, 98? If the two are read together, then 97 is limited to only exceptional. If I say 97 deals with items which are beyond exceptional, material but not exceptional, then it also has implications for your operating segment disclosure. So just that's the reason why I'm highlighting, because IFRS 8 or Ind AS 108 also refers to material items as per 97. When now, like I said, there are two sets, 82, 85, which is more on disaggregation, 97, 98, which is more on exceptional. So I'm going to focus more on 97, 98 for the purpose of this particular discussion that we're having. Now, by nature, what is exceptional will involve judgment. It will depend on facts and circumstances of the case. The question is, how do you apply judgment? There cannot be any exhaustive list. We said, look at frequency, look at incidents, and so on. What are we really trying to do? The question is, when you're applying your judgment, what is the basic purpose that exceptional item is going to serve? Apply your judgment in that context. The whole reason of giving exceptional is so that comparability of income statement over period is maintained. If, let's say, I have an item which is not expected to recur, right? And I don't disclose that separately, my comparability current with previous year will go away. And even next year gets skewed. So the whole purpose of showing an exceptional item is to assist in a better comparison or in terms of performance. So also look at it from that perspective. That does this item impact my comparability with previous year? And when I come to next year, predictive value. So let's say if I have employee expenses, that cannot be exceptional. And by virtue of employee expenses, you're able to compare how has your expense moved from previous year. And if, let's say, I am a user of financial statements, I see this is the level of employee expense in the current year. If I have to project and think about the company's expenses for the future, I know, okay, this is the range in which the expenses would be, right? So the current year expense has a predictive value because I'm able to use that and kind of make some judgment as to what the future, in the sense, in the forthcoming period, how these expenses will pan out. But something which is like I said, not frequently, very rare, right? That does not have predictive value. If I've had that so-called rare expenditure in the current year, it is not going to recur next year. And therefore, it doesn't really have relevance for me, and I would like to exclude it. So in a way, comparability, past comparability from a previous year, how it has moved, and predictive value from a future perspective, think about it like that, and then exercise your judgment as to whether something is exceptional or not. Now, in the current case, I think the way Madhuri was, when she was reading the fact pattern, I was very curious. I went back and kind of was reading the paper one more time, and she's right. One is to say, my judgment is different, between the auditor and the company. Here, I think there is somewhat a disagreement on the fact pattern. The company is saying this is recurring. Auditor is saying this is not recurring. Now, that is actually factual. That I don't think is judgment. So I am going to therefore say, presuming there is no such factual disagreement, if it is very clear that this is in a way something which may not occur every year, but it is not even, it can happen 3 to 4 years. It is not very uncommon. It may not be occurring every 6 months, 1 year, 1.5 years, but yeah, it occurs. It is not unusual, right? I would take it to be a normal. But if it is something which, like I said, has no predictive value, unforeseen, something like that, then of course it is not exceptional. Here, surprisingly, I think from a fact perspective also, there seems to be somewhat difference in how the auditor and the company is looking at it. So the answer that way is very, very simple. I think if we go by the company's representation, this is very common. It happens, not common, it happens. It is not unusual. The EAC, obviously, going by that, has concluded that this is not an exceptional item. But here I just want to take 2 or 3 minutes, because I think it's not just about this fact pattern. The concept of exceptional items on its own requires some bit of deliberation. So if, and why do I say this? Because I do feel, by my experience, and I'm sure Madhuri and Sarika can add, there is somewhat an unconscious bias, when you have an expense and, higher expense, and it's a way of profit, you want to show it as an exceptional. But when it's an income, you don't want to show it as exceptional, right? There you want, it's just about how company may want to kind of, company also has their own, performance, pressure, you want to call it, or whatever, to demonstrate a particular outcome. So there is quite often I've seen the way the exceptional expense versus exceptional income. Now, so like I said, please apply the judgment looking at, like Madhuri said, that nature and extent. Of course, like I said, you look at, when we talk about nature and frequency, you look at it, like I said, from a perspective of predictive comparability. Is it expected, or how does it help a reader in terms of decision making? Now, the Institute, when they have said that this is not an exceptional, a very interesting thing, the EAC has also said, while it may not be exceptional, but if it is material, then please disclose nature and amount. I would have actually said, okay, refer to 85 and then see if it requires a disaggregated. Here, I think the EAC opinion says, disclose nature and amount as per para 97. Okay. And this is now my personal, this thing that I wouldn't go to 97, because like I said, I'm reading 97 and 98 together. I don't believe 97 applies to material which is not exceptional, but I would read it in the spirit, the EAC opinion in its true spirit. I think the intention is, if you feel it can really impact, it is important for a user's understanding, then please disclose separately. I would come to the same outcome applying para 85 in this case. And let's say if something is not exceptional and I want to disclose nature and amount separately, how do I do it? One is, like I said, para 85 says you can disaggregate and show. Okay. I was very curious to, and I was just thinking about myself, let's say if I had to show, how would I disaggregate? Would I split my finance cost into 2, finance cost during force majeure, finance cost during, I don't think that would really work from a disaggregation, but you can disclose the nature and amount in many, many other ways. You can, and I'm just adding here, this is not there in the EAC opinion. Let's say if I have to highlight if it's material and I want to bring it to the attention of the user, then one is I can just have a very detailed note. Okay. My P&L, when I have the finance cost, I can refer to that note. If I want to highlight it even more, I can, in parentheses, finance cost in parentheses, just say includes X amount due to, force majeure or whatever. So you can highlight it. Exceptional is not the only way to highlight it, is what I was saying. And I would, that's how it would go. And in the same paragraph, when you read the EAC opinion, when it's referred to para 97, it is also in the same paragraph referred to para 85. So it says that company should disclose nature and amount as per 97 and also present these items by disaggregating headings and subtotals in accordance with para 8. So I was just trying to see that if I put together the two, how would it work? I think you can, like I said, give a note, put reference to it, put it in parentheses. In certain cases, you may be able to even disaggregate. And like I said, I would use para 85. I'd be more inclined to go towards para 85 because these are material, right? And again, what is material is again very judgment based. depends on facts and circumstances. So if I was to quickly take one or two examples, like I said, how the judgment can change. If you look at foreign exchange gains and losses, depending upon the volatility, if we know, for example, there is going to be some level of volatility as far as foreign exchange fluctuation is concerned. Okay. So if the exchange fluctuation, let's say, if I expect the normal to be 5 to 7% fluctuation is there, I may not call it exceptional. But we've had phases in our economic growth where the fluctuation was, if I can use the word, extreme. Okay. And there I may apply my judgment and say this is normal. While we expect fluctuation to be in a particular range, let's say 5 to 7, I'm just saying, let's say if the currency moved by 30% and for a larger part of the year, not just like 2 days or whatever. So you can have a situation where the same foreign exchange gain and loss can be exceptional. The point I'm trying to make is there's no rule. Okay. The same expense can be for the same company at times exceptional and not, and the same item for different companies can also have a different outcome. So if you see para 98, which I was talking about, gives you some examples of the kind of exceptional items that can be there. It also includes litigation. Now, I want to just take 2 minutes, I'm sorry, because quite often I see at times this is being applied as a rule. So the minute you say litigation settlement or you say a write down of inventory, there is a tendency to say, oh, there is a write down, therefore it is exceptional because para 98 says, or similarly for litigation. Now, these examples are only, if you ask me, illustrative. Second, they're only trying to highlight some nature. By nature, for example, yes, you may say earthquake. By nature, yes, my assumption would be this is exceptional. But litigation, I would say, okay, your starting assumption can be, but you really need to demonstrate. If for whatever reason, like I said, if I look at write down of inventory, if I'm in an industry where write down is common, it does happen. I'm in an industry where, let's say, maybe fashion industry, clothes just move out of, you can't repeat the inventory of one season in the next year and so on. It could be quite common to have write down of inventory. So just see from that perspective. Similarly, litigation, not all litigation settlements would necessarily be exceptional. You can have a situation wherein, let's say, the litigation is so significant. Maybe the settlement has just wipes off your profit and loss account, or it has significant implications in terms of your ability to continue as a going concern, or maybe discontinue as a product, etc. So apply all those factors before you're really kind of concluding whether something is exceptional or not. And as the title itself says, it is exceptional. I think if we have a very frequent use of exceptional, a very low, a very low threshold for classifying something as exceptional, it also takes away its utility. So it is subject to judgment. I would just say exercise the judgment with a lot of caution. Madhuri, Sarika, I'll leave it to you if you want to add anything.
No, thanks, Archana. I think that was quite a elaborate explanation of, how one needs to look at exceptional items. And I particularly like the way the EAC actually concluded to say that, you need to look at it from your context, your facts and circumstances. Essentially, the fact that the force majeure was because of terror was the perception that the auditor had, that that's not a usual thing. And that's why you need to consider something exceptional. Whereas the client was, while the reason might not be exceptional or rare or whatever, might be exceptional, the existence of force majeure clause and the invoking of force majeure clause is not that infrequent. So, that was the reason why they had a different way of looking at the same issue and saying, I look at it as a frequent occurrence, whereas the fact that force majeure happens, whereas the auditor is looking at the reason for force majeure is terror, which is not a frequent event.
But that's a good point. That's a good point. Now, there could be some areas, let's say, which are susceptible to terrorism. Okay, invariably it's a place wherein it's from a security perspective not very sound. Something or the other keeps on happening.
True.
Similarly, earthquake. Japan, you would consider earthquake to be a normal rather than exceptional. So, again, it goes back to facts and circumstances.
Absolutely. Thank you, Archana. And with that, I think we've kept Sarika waiting for quite a long time. And I will move on to the next query that we have. And this one, actually, you alluded to Forex in your examples, and that's what we are dealing with in this particular query. So this is accounting treatment of foreign exchange gain or loss, which arises out of payables for capital goods and services under Ind AS framework. Briefly, the facts. This is a entity that's a JV, 50-50 JV between Government of India and state government. Essentially, it's come into existence to put up a metro system, a mass rapid transit system in a particular location. The company is currently under construction phase and commercial operations are yet to start. There are contracts with vendors towards acquisition of depreciable assets, and these were entered into before the date of transition to Ind AS. This is going to be important when Sarika starts evaluating the query. So some of these vendor contracts were actually entered into before the date of transition. Now, how did the company treat Forex fluctuations? The gain or loss on transactions and translations on payables for goods and services were all transferred to CWIP. What the company planned to do is, once the construction was completed and assets were ready for its intended use, then the gain or loss would be charged off to P&L. That was the plan. Now, let's look at the company's rationale for its accounting treatment. There are a bunch of standards that they have referred to, and all of it put together, they arrived at their proposed accounting treatment. One of the things they looked at is Ind AS 23. Very important to note that they did not just pick paragraph 6E, rather they took an analogy of this paragraph. And essentially, this paragraph is the one which deals with definition, and it kind of talks about what kind of elements can form part of exchange fluctuation. So capitalization of exchange fluctuation, to the extent it is regarded as an adjustment to interest cost. They picked out this one. They also looked at Ind AS 101. Essentially, because we are talking about the transition period, that's the reason why they looked at 101 as well, paragraph D13AA, the one that gave entities an option to continue with the policy adopted for exchange differences arising from translation of long-term foreign currency monetary items as per previous GAAP. And this is where the previous GAAP comes into play, which is the erstwhile AS 11. Those of us who have been around during that period will remember this very famous or infamous paragraph, I must say, paragraph 46A, which was always difficult to kind of, get your head around, I guess. Because essentially what this paragraph did was it gave an option to companies to depreciate the exchange differences that related to depreciable capital assets over the period of the balance life of the asset. Something unusual, but yes, this is what the standard actually gave an option. And a lot of companies did take this option, and which is why you needed to have that transition provision in 101 to deal with this option that existed at that point of time. And lastly, this is the primary contention really, I guess, from Ind AS 16, which is the one related to PPE, property, plant and equipment. The argument really was, can I consider this Forex fluctuation as directly attributable expenses towards, bringing that asset to the location and condition necessary for it to be used as intended by management, and so can I really go ahead and capitalize it with my asset? So considering all of these different elements from different standards, they came to the conclusion that they can capitalize. From the auditor's perspective, a very simplistic kind of a outlook here, where they're simply looking at Ind AS 21, and they're talking about the fact that any exchange difference that arises on settlement of monetary items, or when you're doing a translation, those differences need to be taken to the profit and loss in the period in which they arise. So their logic is simply that now you're under Ind AS. This is what Ind AS requires you to do, so take it to P&L account. So the query raised to EAC really was, these Forex fluctuations, how do we treat them? Can we by any chance consider them for capitalization by utilizing all of those standards we spoke about, but essentially in AS 16 and call it as directly attributable and capitalize it with the asset. Over to you, Sarika, and sorry to keep you waiting this long.
No, not a problem at all. And actually, you made my job easy, giving detailed guidance and the perspective from the company as well as the auditors. Thank you so much. And before I get into the discussion, my heartiest wishes for the Women's Day. It's not easy to be a woman. It takes a lot. So I had today posted one LinkedIn update also giving the quotes from my female power, my team, both from ESG and technical. So if you get time, just look at that as well. You'll feel empowered further. And secondly, the way I am going to start my discussion would be something echoing the voice of the committee, because the points which we are going to discuss might not necessarily be my views, because a lot of efforts has already been gone into deliberation and the way the committee has looked at multiple iterations and decision, etc. So I would rather follow the footprints of the committee, how they have looked at, barring a few instances where I would like to add some experiences of mine or some more explanations to some of the aspects. And sorry for the bad voice, these days a lot of speaking on, not on the technical part but on ESG. A lot of things are going on, so I'm feeling home back today after so many days. I'm speaking on some technical accounting issues. So past 2 years it's always been ESG, BRSR, etc., etc. So I'm feeling recharged again. And I think in this committee, this is my first session, so the forum and the way, the methodology is slightly different. So I'm trying to match up with the expectations. So let's see. So thanks again, Madhuri. You did summarize the query in a very wonderful manner, giving your perspective very briefly. So just a few important points which I would like to pick up from the facts and the guidance which has been quoted by the company, etc. So the company is building the metro connectivity facility. And why I'm emphasizing more on metro connectivity facility, because that will add up to or will link this to the borrowing cost, because that seems to be a qualifying asset where part of the foreign exchange gain or loss, which is intended by the company to get capitalized, will be covered through Ind AS 26. So this is a metro connectivity project which is under the construction phase, and the company intends to capitalize certain foreign exchange gains or losses arising out of long-term foreign currency monetary items, precisely payable on the foreign exchange, which are directly attributable to the construction activity. One very important point which was made by Madhuri as well, the primary contention of the company is focusing, and that's where the query is also framed around, under Ind AS 16, where all and everything the company wants to capitalize, whatever remaining it is, wherever the benefit he can take under Ind AS 16. However, he has also made a comment that post completion of the project, that is intended to be charged to the profit and loss account. That's how the entire facts revolves around the query. So the guidance which has been quoted by the company, or rather not guidance exactly where he has taken the guidance from, but he is trying to draw the analogy out of certain standards or certain paragraphs where he can get the maximum benefit to capitalize. So the first analogy what is being drawn by the company is para D13AA of Ind AS 101, which gives the company an option to continue the previous policy adopted by the company with regards to the foreign exchange differences arising from translation of long-term foreign currency monetary items, which are recognized as per the previous gap. So here, the very important point which Madhuri also told us, that was a sunset clause which was issued way back, where the companies were allowed to to choose an irrevocable option to be applied for all long-term foreign currency monetary item, where they could capitalize the foreign exchange difference, which was relating to the acquisition of a depreciable capital asset and can be adjusted across its useful life. That was unusual though, but that was the benefit which was given. Prior to introduction of para 46A, there was another sunset clause, which was para 46, and 46A was an extension of it. And she rightly said, whoever was around that time, I was there. So I very well remember I was with GT that time only. So we were preparing analysis, and there were a lot of hues and cries and around the same. What does that mean? The previous one did give the closing date, para 46 didn't. The company also draws analogy from Ind AS 23, para 6E. That's a very specific clause which allows, as a part of borrowing cost, the capitalization of foreign exchange fluctuation to the extent it is regarded as adjustment to the interest cost. So there is a specific formula sort of a thing which has been given under the standard, where you have the delta between both the currencies, and to that extent you can use, or you can consider that amount as foreign exchange fluctuation, and you can consider it as a borrowing cost, and you can capitalize it provided the other conditions of Ind AS 23 are met. So I just repeat, the client or the company is taking analogy from 3 standards to start with. Para 101 D13AA, where it wants to continue with para 46A of AS 11, and Ind AS 23, para 6C, very specific, when part of the foreign exchange fluctuation can be considered as borrowing cost. And last but not the least, as a residual measure, the company has used Ind AS 16, para 16B, where it talks about capitalization of all the items which relates to the building up of an asset which can be capitalized. However, the company restricted its query only to the query related to Ind AS 16, whether the accounting of capitalization till the time it actually gets its commercial production started is tenable or not. That is the basic query. So I am, as I mentioned, I'm echoing the voice of the committee. I am going in the flow as the committee is going and has done the deliberation on. So committee mentioned that the basic issue of accounting is consideration of foreign currency payable, the translation loss or gain on the foreign currency payable with respect to capital goods or services which are not ready or for intended use under the Ind AS framework. Is it this is done, whatever is done by the company is correct or not? That is the basic question. Any other accounting which may arise from any other foreign exchange transactions, or accounting for any other expenses related to this metro project, or any other borrowing cost, or translation of non-monetary items has not been considered by the committee. So as we initially understood, we have to take these EAC opinions as guiding principles wherever we can match our fact pattern with the query, and cannot be and should not be used as it is. So that's what the committee also mentioned. How the committee countered the company, let's understand that flow of the transaction. So committee understand that there were certain contracts existing as on the date of Ind AS conversions by the company. And for those contracts, the company had already availed the benefit of para 46A of erstwhile AS 11 before that Ind AS conversions happened. So there were certain contracts which related to the depreciable asset, the acquisition thereof before Ind AS conversion. The company had used the benefit of para 46A of Ind AS 11, and the company further used the benefit of para 13AA of Ind AS 101, where it continued the practice which was allowed by erstwhile AS 11, and it has capitalized the foreign exchange differences arising from translation of those long-term foreign currency monetary item and recognized as per previous GAAP only. So that was the flow of the transactions so far as considered and as observed by the committee. Committee further quoted a couple of more guidance from Ind AS 21 as well, to complete the transaction and to opine on the fact of the matter. They very categorically mentioned para 7AA of Ind AS 2021, where they categorically says that this standard exempts those long-term foreign currency monetary items for which the exemption has been taken under Ind AS 101. And since the company has already taken the exemption under Ind AS 101 through para D13AA, therefore, Ind AS 21 to that extent would not be applicable. And hence, whatever the company has done to that extent, which relates to the previous cap before Ind AS conversions, is okay, is fine. Committee further quotes two more paragraphs out of this standard only, para 28 and 29. That's a normal recognition principle for foreign exchange differences arising on either the settlement of monetary items or translating those to be recognized in the profit and loss account. The point here to be noted, why committee quoted a very simple guidance, which is the basic premises of the standard, is that whatever residuary foreign exchange gain or loss the company intends to capitalize cannot be capitalized, and the base of negating that contention are those two paragraphs. Now coming to Ind AS 23, the committee also read through that and considered that and found that validly the company can take a plea of borrowing cost which are falling within the ambit of Ind AS 23 and specifically within paragraph 6E, which allows the foreign exchange differences arising on foreign currency borrowing to the extent they are regarded as an adjustment to the interest cost. And I'm sure everybody knows what does that mean, to limit it to the adjustment to interest cost. So based on these paragraphs, Ind AS 16, Ind AS 101, Ind AS 21, and erstwhile AS 11, if we read through these standards collectively and the paragraphs which were quoted by Madhuri and myself, again reiterating, if we collectively look at and break down the foreign exchange gain or loss in different manner and typically taking a base of Ind AS conversion, then we would be able to reach to the conclusion what has been given by the committee. So committee categorically said, and I have also said that to the extent those long-term monetary items were recognized before the conversions of Indian accounting standard by the company, that means Ind AS conversions, and they adopted the paragraph as allowed by Ind AS 101. To that extent, they can continue to capitalize those foreign exchange differences. There is no doubt about it. So that is allowed. However, if any of the long-term foreign currency monetary items related to similar contracts was recognized post adoption of Ind AS financial statements or conversions strategy of Ind AS, that is not allowed. That means after the first Ind AS financial reporting, what the company might have done, anything what has been recognized related to the similar contracts will not be and should not be allowed. The third category, what committee allowed to capitalize it through the borrowing cost, that's a very independent aspect of it. So as we just mentioned, if Ind AS 16 allows through para 6E of Ind AS 23, I'm so sorry, then those borrowing costs, and in this particular case, it seems more likely because the metro project seems to be a qualifying asset because it's a long-term project and it takes a little longer to complete, etc. If other conditions are met, those foreign exchange gains and losses can also be additionally capitalized. That is for sure. After that, as a third point, what committee has mentioned, any other foreign exchange difference which arises on translation of foreign currency monetary items or payables at the reporting date, which is under question, has to be recognized under or within P&L as per Ind AS 21. So those two paragraphs which I read through, that was the reason of quoting those paragraphs specifically. Lastly, and which is very, very important point which committee made, that since the foreign exchange gains and losses are specifically dealt with in Ind AS 21, therefore, the general requirements of Ind AS 16 would not be applicable in those cases. So the committee net divided those foreign exchange gains and losses in 3 items. I just summarize quickly. First, prior to Ind AS adoption, they can capitalize it, continue to capitalize it rather. Foreign exchange gains or losses after the Ind AS conversion on long-term monetary items, which are recognized post that, are not allowed. If independently the borrowing cost can be captured within para 6E of Ind AS 13, they have the opportunity to capitalize it as a separate standard applicability. Any other foreign exchange gains or losses on foreign currency monetary items not allowed, and applicability of Ind AS 16 rather as a general measure is not allowed at all. That was the summary of the opinion what was given by the committee, unless Archana and Madhuri has something to add.
No, thank you very much, Sarika. That was really helpful for everyone to understand how the EAC actually broke up the entire elements and clarified to people how an analysis needs to be done. I think more than just looking at the result of what the EAC opinion stands for, I think the concepts that it clarified is going to be quite helpful in a number of cases. So thank you very much for that. With that, I'll move on to the next query. This one is with respect to a topic that all of us deal with. I don't think anybody in the audiences has not dealt with expected credit losses, ECL. And the query that we are going to look at is essentially dealing with factoring time value of money while calculating ECL on a specific element, that is deferred debt, which is retention money under Ind AS framework. A quick look at the facts. So essentially, in this case, it's a company that is manufacturing integrated power plant equipment. What we understand is the execution period for the projects that this company undertakes is over a period of 3 to 5 years, so mid to long term, and billing is done on a progressive basis. They have concluded that for the purposes of revenue recognition, performance obligation under 115 is satisfied over time, and they use the input method based on cost approach to record revenue over the period. With this, there's also a specific clause in the contracts that they enter in. Essentially, there is a specified percentage of each milestone payment which is withheld by the customer, and this is paid to the company eventually on completion of further milestones. So essentially a retention clause. The reason why there is retention is to protect the customer from company's non-performance. Again, very important to kind of note. The reason for retention is to ensure that if there is non-performance by the company in future, the customer has some sort of a fallback mechanism. That's the reason for the clause to be included. The ECL provisioning. How does the company, what's the policy of the company? Essentially, it's looking at Ind AS 109. It's following a simplified approach. So ECL on trade receivables, including deferred payments, is on a case-to-case basis. However, when they are looking at retention money, that is this deferred debt, they are not considering time value of money, with their logic essentially being that this is really not relating to any financing, etc. The purpose of this is not, or the implication of this is not relating to any kind of a financing component. It's purely to protect the customer from non-performance, and that's the reason why time value of money should not be considered. So the question really here is whether the company should factor in time value of money while providing for ECL on retention money or not. I'll take this back to you, Archana.
Thank you. Thank you. I think this is an interesting one, actually. When I started reading this EAC opinion, I thought so easy. I mean, what is the question here? Okay, but I will, sorry, I'm going to take it. My approach is a little different. While I'll summarize what the EAC has said, I want to deliberate it a little further. And while I'm maintaining the sanctity of the EAC opinion, but I'm just saying, how do you further take that as far as practical application is concerned? So I'm not an FI expert, but I will therefore, I do not know how many of the participants are, but to make this easier, if I can just summarize some of the key principles of ECL, and I think the EAC opinion also summarizes these. So what it's inconsistent with the EAC opinion. Now, first bit is that this is a situation where the company is into, let's say, construction contract, and there is retention money, quite common for that sector, right? One of the disclaimers that EAC has said is that this retention money, whether it is trade receivable or contract asset, they are not commenting. Okay. And I think that's a very interesting bit. And it got me thinking when I read about the disclaimer that, okay, they have not said, but what would it be? Okay. I don't think the ECL analysis really changes because of that. But since that issue came up, I think I just want the participants to think about it. That if you've got, let's say I have a 5-year construction contract, every year the work which I've done, whatever, let's say whatever is earned and due, let's say I'm going to be paid 95% of that, 5% is going to be kept as retention money. So that keeps on accumulating, that retention money. Now, am I going to get my retention money at the end of the contract just by virtue of lapse of time? Probably no. That's not how most of the retention money clauses work. The retention money is kept, like you explained in the fact pattern, is also because you look at the performance. You look at whether the asset is performing as intended, and then it is released. So in a way, the ability of the company to get that retention money at the end of the contract is somewhere dependent on just mere lapse. So again, this is my personal thing. EAC opinion doesn't cover, but I think this would be somewhere a contract asset. And but it's got me thinking, and I think we should, it'll be good to even see how the industry is kind of classifying it. Now, like I said, whether it's trade receivable or contract asset, I don't think the answer really differs, because even though contract asset per se, if you see, it's outside 109. Okay. However, for the purpose of impairment, it is within the scope of 109. So overall, IFRS 15 or India's 115 applies for contract asset, but for impairment purposes of contract asset, you still go to India's 109. So trade receivable, contract asset, invariably, this will apply. The next bit I wanted to kind of, so that was the first principle. The next principle which I wanted to clarify is that when you look at how ECL will be calculated, okay, it requires, the standard itself is very clear. That's why I said, okay, what was the question here? Because if you look at the standard requirements, it very clearly says while looking at ECL, you've got to factor in the time value of money, right? Now, I can just stop here. And say, okay, the ECL requirements in the standard, if you look at para 5.5.17, it says an entity shall measure ECL in a way that reflects an unbiased probability weighted amount, time value of money, reasonable and supportable information. I'm not reading the whole thing, but it clearly refers to time value of money. So I can just stop here. Now, the interesting bit, why is this question really coming up? Now, if you, again, going back to the ECL model, if you look at trade receivables and contract assets, the standard has a simplified model for them. So and that is subject to condition. So let's say I have a trade receivable or a contract asset. If there is no financing element involved, that's a condition, then you can use a simplified model. And what does simplified model mean? Simplified model means you do a lifetime ECL rather than a 12-month and so on. Now, the way I saw this was that if, let's say, there is no financing element, what does this mean? Typically, it would mean that my trade receivable probably is due within 12 months, right? Because if it was for a longer period, you would not be able to even use the expedient in IFRS 15 or 115, and you will have to impute financing. The fact that there is no financing element, if I'm in that category of trade receivable with no financing element, means it is expected to be recovered or realized within 12 months. And if I go by that, whether I do a lifetime ECL or whether I do a 12-month, outcome will not really differ. So the first principle, trade receivable, contract asset, if no financing element, please applies simplified. You actually have to, there is no choice. You have to apply simplified model, which is lifetime ECL. In certain other cases, you have a choice, but in this case, you don't have a choice. Now, let's say, like I said, in my case, in the example I'm taking, no financing element. If there is no financing element, which means EIR is 0, right? There is no effective rate because there is no financing element. So typically what happens is if there is no financing element, your EIR will be 0 and effectively there will be no discounting as far as ECL is concerned. If you go in the normal course, I'm just trying to give that background so that you can appreciate this question which has come up. So think about a trade receivable that your client has, recoverable within 12 months. Obviously, there is no financing element, or if there is also, you have applied practical expedient. You're not doing discounting of your, your initial recognition of revenue is at the transaction price. There is no discounting. Okay. And therefore, your EIR is 0 when you're looking at ECL. Like I said, ECL says take into account time value of money. And further, when you look at the standard says when you're looking at the time value of money, you use for the purpose of that, you use the effective interest rate at the transaction date. In the normal course, my effective interest rate for such trade receivables or contract assets will be nil, right? So practically, therefore, if you see, there is no discounting because usually there is no financing element and EIR is 0. But this fact pattern becomes very interesting. In this fact pattern, I have my receivable, which will come, let's say 3 years, 5 years, or whatever, whenever the project is over. Let's take a 5-year project term. It'll come after 5 years. Intuitively, you will think, right? There is a financing element. If I am going to, Madhuri, if I'm doing a project for you, if you're going to pay me after 5 years, there will be an element of financing, which I will add to my price that I will quote to you. However, this is again what I'm saying is, I think an interpretation, but it is well accepted and well settled. IFRS 15 or Ind AS 115 says that if you can demonstrate that the deferred payment term, the payment has been deferred for reasons other than financing, you need not do the discounting. So in a normal course, let's say my revenue transaction, the transaction price is so-called, let me not say the transaction price, my invoice price is, let's say 100. My typical credit period is 3 months. But to you, Madhuri, because you're such a good friend of mine, I say, I'll, pay me after 2 years. So there is a financing element, and I gave it not for any other reason, but because I felt you have liquidity challenges, I'm expected to discount it. But if I can demonstrate this extended period was for reasons other than financing, okay, then I'm not required to discount. So in this case, in retention money, I'm not, the practice or the way the standard has been very well, like I said, it's well accepted now, the interpretation is that the retention money is deferred. It comes after the end of the project. The deferral is not for reasons of financing, but because the buyer or my customer wants to be sure about the performance of the asset. Okay. Now you can argue that, okay, it is deferred for that reason, but you would have still added some financing element. Whatever be the reason, I would have in the pricing figured it out. So very hyper-technically, you may say there is still a financing element, but like I said, the way the standard has been interpreted, applied, is that retention money is something which is deferred for reasons other than financing, and we don't discount. Why am I discussing so much on retention money discounting is because the same issue then comes in this context of query. Here, the company is saying that I have retention money, but that retention money does not have any element of financing as per Ind AS 115. My ongoing payments of trade receivables also do not have any financing element. They are as and when I bill them, I get them within 12 months. So there is no element of financing when I look at Ind AS 115. And therefore, can I, for the purpose of ECL on retention money, also say EIR is 0 and not do any discounting? It's a very beautiful point. Now, if you look at the EAC opinion, the EAC opinion has, in a way, just reiterated the requirement. EAC opinion just says that that the standard requires you to take the time value of money into account. Then the EAC has also gone into and kind of reiterated the simplified model. The fact that the simplified ECL approach under 109, and it says that company can measure the loss allowance at an amount equal to the lifetime expected credit loss for trade receivables. And then they've gone on to say that in accordance with the standard, this ECL should also reflect time value of money. Now, they've also kind of said, okay, typically how is a simplified model applied for the purpose of trade receivable? And it says that you do have a provision matrix, which is as a practical expedient, which is used. And when you are using this provision matrix, you are applying an ECL rate. So the EAC opinion says if your ECL rate includes the time value of money, great, you don't need to do anything. But if your ECL rate does not include the time value of money, then you should cover over and above. That is where it stops. Now, I'm hoping I'm taking the permission of EAC just to go now, okay, after if I was the querist and I've received it, what will I do? So let's say my ECL provision matrix, the ECL rate in the provision matrix does not represent time value of money. I've got my simple ECL rate and I've got my total receivable. So in this fact pattern, the EAC has said, consider the time value of money. The question is, what is time value of money for me? Okay. I personally, and I'm adding this in my personal, if I read the entire thing put together, even the fact that I do not have any financing element as far as India's 115 is concerned, my revenue is being recognized as transaction price. The retention money is also being deferred for reasons other than financing. There can be a good case to say my EIR is 0. Okay. But like I said, the EAC opinion stops at a principal answer to say you need to, which is absolutely correct. You need to factor in the time value of money. My own struggle was, what is the time value of money in such a case? There can only be 2 options. One is forget 115. Okay. Even though there is no financing element, I still, because I know I'm going to get it after 5 years, I still impute an EIR and I build that in. The other is to say, no, the EIR has to be calculated only the way it has been done under India's 115. You first look at the element of financing as per 115. I seem to be more in the second category. And I think my understanding is that practically this is how it is being applied. So just to do a quick recap, I will, if it's okay, because I know I've gone back and forth on many things. So if I can just do a quick recap, intention was not to confuse people, is that trade receivable, contract assets, both are covered. For ECL, it applies to both. ECL measurement requires time value of money to be considered. As far as a trade receivable or a contract asset is concerned, if there is no financing element, then you are required to follow the simplified model of ECL. And that means you do a lifetime ECL recognition. There is 109 recognizes for the simplified lifetime ECL. It recognizes the use of a provision matrix. The next bit is, okay, as far as time value of money is concerned, usually for trade receivables, we will expect the 12 months to be equal to the lifetime ECL. Usually they will, in a trade receivable which is recoverable within 12 months, EIR is 0, and therefore in practice, effectively, there is no discounting. When it comes to retention money, this is different. Retention money has its own peculiarities, but even there, a case can be built to say, if it can be demonstrated that the retention money is being held only for performance reasons rather than for any financing purposes, then I would suggest each company to look at their own case, see what is the EIR. I have seen many cases, and I would presume a logical answer is that EIR would be maybe 0, yeah.
Thanks, Archana.
Have I confused further?
No, absolutely. I think it is for the audience to kind of, evaluate what applies to their case and kind of, conclude based on that. But thank you very much for that. And I will move on to the next query with that. The next one is again on quite an interesting topic, service concession agreements. Again, this was something that fascinated a lot of people, including me, when the standard initially came in, and it was something very different from what we were used to doing in accounting. And I guess it was also right around the time when the government started coming up with these public private projects, which gave rise to a lot of such need for having the guidance for such kind of accounting. And now we seem to have a new form of contracts which NHAI is coming with, and let's take a look at how these work. So the next query that we have is accounting treatment of hybrid annuity projects under Ind AS framework. So in this case, we have an SPV. Typically, when NHAI awards any kind of project of laying down roads, etc., there is a bid submission process, and the company that actually wins the bid is required to set up an SPV. Essentially, what NHAI would want is each project is dealt with by a separate SPV, which completely focuses on and is completely dedicated to that one particular project, and it doesn't get mixed up with other projects, etc. And so the company that is actually eligible for bidding, which is the holdco, will have to set up an SPV for that particular project, which for which they've got the concession. So that's really how it operates. Now, in this particular case, what we have is we have H Limited, which is the holdco, 100% holdco of the SPV. The SPV was specifically set up to undertake a particular highway project awarded by NHAI. It was to construct a 4-lane highway in over a period of 2 to 2.5 years. That's the EPC part of the contract. And after that, for 15 years, it had to operate and maintain this 4-lane highway. Now, in terms of how the company is getting remunerated for this, during construction period, NHAI is releasing 40%, essentially 4% payment on each milestone for a total of 10 milestones. After construction, 60% is going, the remaining 60% comes as biannual equated annuity along with interest. For the EPC part of it, the SPV awards turnkey EPC contracts to H Limited, which is the parent company, and will make 100% payment of the EPC work during the construction phase itself, right? Now, a few other important clauses which are relevant for the query that we have. I'll try to kind of make it as simplified as possible. The total bid project cost, the contract value, includes a few elements. One is, of course, the EPC cost, the construction cost that we are talking about. There's also a loan taken, and to kind of finance the 60% remaining amount. So the interest during construction on that loan is also part of this total bid project cost. There are other pre-operative expenses. Since there is a loan, there is loan processing fee, there's audit fee, engineer fee, etc. And key elements to note, which are also kind of forming a basis for the company's contention, really, that the SPV cannot undertake any other projects. And once the project is completed, the SPV mandatorily needs to be dissolved. These are again preconditions that NHAI has in each of the contracts that it awards to companies. So this is essentially a precondition that one project at a time, once the project is over, the entity needs to get dissolved. There are other costs that will be incurred during the time of maintenance, essentially the O&M expenses that will be incurred and reimbursed. This is separate from the total bid project cost that I spoke about earlier. One last element, the SPV cannot collect toll charges from public during the O&M period. I guess most of the audience would know what that means. Essentially, there is no intangible asset that is getting created in this case, because there is no toll collection right to collect toll as such that is existing under this contract. So what is the accounting done by SPV? The SPV has looked at Ind AS 115 Appendix D, which is on service concession arrangements specifically. So during construction period, revenue is recognized by taking cost incurred till date plus margin. And what is recognized is the financial asset. So that's what is appearing in the balance sheet. And also the fair value of the transactions calculated considering the project project's cash inflows and outflows over the period, the difference between cash flows is what is represented as finance costs, derived on the basis of effective IRR on net cash flows, finance income. Let me correct myself. So this is really the accounting done by the SPV. As all of you can see, there are multiple questions that the queryist has really raised in terms of borrowing costs. But the essential question that the queryist has asked is, what can I do with my borrowing costs? Now that I have a financial asset, I don't really have any other asset in my books. I'm only doing one project at a time. If you can look at point number 3 there, the SPV was created only for the business of constructing and maintaining this one single project, and nothing else can be done. What is the total cost on which I can actually capitalize my borrowing cost? Is there any way that I can treat my borrowing cost differently, or should I take it to P&L? That is essentially in crux the question that the queryist is asked. Over to you, Sarika.
Thanks, Madhuri, again to beautifully summarize the query. And I would like you to stay on this screen first, because I would like to bucketize these 2 queries, these 4 queries in 2 buckets that will help me later while I would be summarizing my answers. So if you look at the first query, what you can see on the screen, that relates to borrowing cost, that includes the interest cost and financing cost, and it relates to the revenue recognition part. So the first query is borrowing cost inclusion while I am using my input method to calculate or to do my revenue recognition exercise. That is the first query. The second query relates to borrowing cost capitalization or consideration of the borrowing cost while I am taking care of my financial assets. Right. So the first point would come from Ind AS 115 per se, and financial asset part we have to see again from Ind AS 115 Appendix D only, but that is through a very different logic, and therefore beautifully that company has raised the second question, because if I fail on the borrowing cost capitalization while I'm doing my revenue recognition, am I allowed to take care of that borrowing cost while I am booking my financial asset? That's the second query. If you look at the third and the fourth query, these are almost the similar query as of first and second, but a very important point which committee also made here is, while for the first set of queries, they have considered the interest cost or the financing cost, but for the second set, I'm presuming as written in the query as well, they had submitted some draft examples as well. In the second set of query, they had not considered the financing cost and the interest part of it. So similar 2 questions have been raised in a different manner in the second part. So let's go back to the facts first. So Madhuri has very elaboratively detailed all the facts pattern. I have picked up a few so that I can rope in my answers based on those. So this is a combination, as she also mentioned, this is a hybrid annuity mode HAM project, which is a combination of EPC, which is engineering, procurement, and construction projects, currently prevalent. Most of it, most of the companies do prefer that, and the build, operate, and transfer projects. So this is a hybrid or combination of it, where the company is required to, engineer, procure, construct, build, operate, and transfer at the end of the life. The company would not own the project at the end. The company is only entitled to some fixed amount during the construction period to the tune of 40%, and remaining 60% when it is entering into the zone of operation and management. That is for 15 years. So the total project is for 17 years, so to say. Once the company is done with the initial part, which is construction part, it borrows some amount which carries some interest, and that's where the problem starts with the company. So what the company has done, it has considered that as borrowing cost. So I would like to divide this query in 2 parts. One with respect to the revenue recognition, and second is with respect to recognizing the financial asset or my intangible asset, so to say. And Madhuri has already answered that, but that query that it would not be an intangible asset as per Appendix D. Why, we will just discuss. So again, it's a combination of two types of projects. It has a period of 17 years, 2 years for construction, 15 years for operation and maintenance, and then it will be transferred to NHI. I'm picking up few key points which will ease out the path to reach to the conclusion. I would like to invite your attention here because this is a very important point. The total project cost, what has been considered by the company, comprises of all the construction cost, interest cost during construction period, where the company has taken a loan for remaining 60% amount, and other pre-operative expenses. So what the company did, they combined everything as a project cost, and based on that cost, putting some margin on it, they had considered that revenue recognition as per Ind AS 115. Right? As Madhuri said, the company does not carry any right of the ownership or toll collection also during the operation and maintenance part. That right rests with NHAI. The company, this SPV, will dissolve once this project will be completed. So there will be no other assets in the balance sheet of the company. The company has chosen Appendix T to account for this service concessional agreement, Ind AS 115, and we'll discuss how the committee has disclaimed it. As per the company, they have applied Ind AS 115, and as per the company, during the construction period, revenue is to be recognized taking the cost incurred till date plus margin, as I just mentioned, and corresponding financial asset has been created. Again, I would like to invite your attention back to my line here. While recognizing the financial asset, currently they have also considered the entire cost pattern, what I have just said. That means all the costs which they have incurred, the interest cost during the construction period, other borrowing cost, and other pre-operative cost. And therefore, the question we had also discussed together. So they had asked 4 questions. First of all, the borrowing cost, including the interest cost and the financing cost, can be considered as total cost while the company is calculating or projecting the revenue amount after putting the margin. That is the first question. The second question is, while the company is recognizing the financial asset, so they have considered it as cost plus margin, which is equivalent to revenue amount. Can this be considered taking the borrowing cost as part of it? That is the second question. That is one set of questions. Similar questions they have asked in a different manner. Considering the SPV is the only carrying single project, will the borrowing cost will become the part of the total cost base? That is the second question. Here, they haven't asked anything specifically about the interest cost or the financing cost. The last question is the borrowing cost. If, as per the principles of Appendix D, if it is charged to the P&L because it may not qualify as a qualifying asset, then the specific question is, will this accounting restrict the borrowing cost that it cannot form part of the financial asset? That is the last and very important question. All these 4 questions, as I mentioned, has to be derived from 2 basic conclusions: whether the revenue recognition, what we are anticipating, will carry my borrowing cost. Secondly, what are the principles of recognizing my financial asset or intangible asset as per this appendix? If that allows to capitalize my borrowing cost, I will take it. If it doesn't allow to capitalize the borrowing cost, I will ignore it. So if we reach to these 2 conclusions, whether the revenue recognition should have the borrowing cost, that is one. And while recognizing either the financial asset or intangible asset, will borrowing cost under question will be considered or not? That will give me the answer for all those 4 questions. So as I said in my previous discussion as well, I'm going with the flow of committee. Wherever I am required to, I'm adding my points as well. So the presumptions taken by the committee, they restricted their answers only to the treatment of the borrowing cost, and they assumed that the input method, what has been considered by the company for revenue recognition as per Ind AS 115, is appropriate as per their examination. They have not re-examined that. They haven't done any fair value estimation, treatment of pre-incorporation expenses, etc. They restricted their answers to the treatment of borrowing cost only. As I mentioned, the company seems to use the input method for estimating the measurement of progress over the time as per 115. The committee also received some illustrative examples, and as I mentioned, at one place they considered interest cost, at other they did not. Would not make much of a difference. While we conclude, we will discuss how. So just to reach to the conclusion, let's understand what all guidance has been considered by the committee. The entire guidance revolves and emanates from this Appendix T of Ind AS 115, which talks about service concession agreement. And committee and we personally believe that the selection of this guidance is appropriate as per the limited facts what we have received. We have not verified it, but we are going with the flow. We assume that is the right selection. Now, coming to Appendix T, first of all, as I said, I will break down my query into two: financial asset part or intangible, that is one. Secondly, revenue recognition. So, first of all, we are discussing whether it will be a financial asset or an intangible asset as per the principles laid down in this Appendix T. So it says if an operator provides any construction or any upgradation services, so the consideration which is received or receivable to the operator has to be recognized in accordance with 115. This consideration might be either in the form of a financial asset or intangible asset. There is no ambiguity. There are certain contracts which gives the hybrid of it when the standard asks to bifurcate it. We are not going into that because we are either reached to a conclusion that it is a financial asset or an intangible asset. So as per the guidance, the financial asset is to be recognized only to the extent when the operator or has unconditional contractual right either to receive cash or any other financial assets where the amount is specified or determinable, or the company, the operator has the right to receive the shortfall from the grantor. In those cases, the company would recognize the financial asset. On the contrary, if the company has a right to charge the users of the public service the amount, then it will be considered as an intangible asset. So the query is very, very simple and says that that intangible asset cannot be accounted for in the particular case because the company does not have the right to charge the toll from the public. So we have concluded that it is a financial asset. Now coming to the further level of diagnostic, how we have to reach the conclusion about the borrowing cost. So now paragraph 20 and 22 of this Appendix D talks about that operator shall account for the operation services in accordance with 115. And this also tells that as per Ind AS 23, and that is a very, very important paragraph to quote, which will address our first query. So as per this Appendix D, it refers to Ind AS 23. It says borrowing cost attributable to the arrangement shall be recognized as an expense when it is incurred unless the operator has contractual right to receive the intangible asset. Meaning thereby, had it been an intangible asset, we would have capitalized, or else we have to charge it off to the P&L. So that addresses my first query. Since it is not first, the second query, but one of the queries, it goes to say that since it's an intangible asset, the borrowing cost related to that asset has to be expensed off since it's not an intangible asset. So that addresses first part. Second, now, so I concluded one query in between when I was just discussing this thing, but that will help later at. So the points which the company made and the points which were considered by the company and as detailed by Madhuri also, the contractual value has to be received in two parts, 40% and 60%. And as we said, there is a unconditional right, and the company does not have any collection rights, so it's a financial asset. Appendix T also talks about revenue recognition from construction of operating assets, as we just discussed. So the revenue part will be considered as per 115, but since it's a financial asset, the recognition and the subsequent measurement thereof will be accounted for as per Ind AS 111, right? So the borrowing cost, which is under question, has to be expensed off, as we just discussed, because it is not an intangible asset, it is a financial asset. Further, the committee also notes that the company, so we have concluded one answer. Now we are going towards the first query, which is about the inclusion of the borrowing cost in the revenue. So the company has used borrowing cost as a part of the entire project cost. So the contention of the committee here is that the company seems to have used this as an input method for determining the progress of measure input, right, as required under Ind AS 115. So committee again has not examined, and we can't also examine whether using the input method is correct or not in the current case, but we can go with the logic and then we can negate what the company is saying. So as per the requirement of, if I read together Ind AS 115 and this Appendix T, input method recognizes revenue on the basis of entity's efforts or inputs to the satisfaction of the performance obligation. For example, the number of labor hours spent, or the resources consumed, etc., etc. How much I am putting my efforts, how much input I am putting to satisfy the performance obligation. If that is not the case, then the company has to exclude from the input method those items that do not depict the entity's performance in transferring the control of the goods or services to the customer. So I just paraphrase my the things which I just stated. The company can only use the company can use the input method. That's not under question. But while using the input method, what all can go as an input will be derived from the fact that whether that input is adding to the performance obligation. It is required in the entity's performance in transferring control of the goods and services. If it is otherwise an obligation of the company, just like this interest cost, then it should not be considered as one of the inputs in the present case to be added for the purpose of revenue recognition. Right? Since in the current case, borrowing costs incurred by the entity are incurred to fund the activities of the company rather than to fulfill its performance obligation. I just repeat, the borrowing costs which are incurred by the company in the current case are not incurred to fulfill its performance obligation, but to fund its activity. That was the need. Therefore, should not form part as input for the purpose of Ind AS 115. That addresses my first query, wherein the revenue recognition, while I'm doing that exercise, am I allowed to capture the borrowing cost to that extent of interest cost or that financing cost? I am not allowed to. So I just summarize my deliberation so far. First, for financial asset, since it's a financial asset, the borrowing cost has to be parked to the profit and loss account. That cannot form part of the P&L, irrespective. Second is, since the company is using the input method, the borrowing cost which are incurred through the input method used by the company is not to fulfill the performance obligations of the company. It is to fulfill the fund requirement, and therefore cannot be considered as part of the input, therefore has to be excluded from the total cost while recognizing the revenue. That addresses all the four queries. Over to you, Madhuri, back, if you have anything to add, or Archana.
Thank you, Sarika. That was very helpful in understanding the nuances, really, of what it takes to kind of, get a service concession contract accounted for correctly. I think we have time for one more query. And now we kind of, from all the different kinds of expenses that we have gone, how can we ignore employee costs, right? That this is again something that is very common and something that most of us deal with very regularly. So in this case, it's a slightly different one, and that's where I think the challenge is in terms of figuring out what kind of a
Madhuri,
liability.
sorry to interrupt, but I was just saying because we just have a little time left, maybe we can just check if there are any questions to be answered, because then we may be very short
Sure.
time. If no
Sure, the
question,
team will. Yeah.
if there's nothing, then let's move to the next one. Yeah.
Thanks, Archana. Right. So this one is on accounting for companies' liability towards Social Security Scheme Fund as per Ind AS 19. Now, in this case, the confusion is really in terms of classification. Where does it really sit? Is it a defined contribution plan or a defined benefit plan? So let's take a look at the background a little bit. So this is again a large undertaking which has decided that they will provide a specific financial assistance to dependent family members of employees who died during service. What is important to note here is this is something that is given out to the family members or the dependents of the deceased employee, and the employee needs to be in service when death occurs. So this is not really post the service period. So this is while the employee is still in service. Now, what has really happened during the period is that till 21-22, there was a different mechanism being followed. And from 22-23, the company introduced a change, and that's the reason why the query has really been raised. So till 2021, this obligation of giving financial assistance was serviced through insurance policies. The company essentially looked at an insurer who they could pay a premium to, and the insurer would then kind of meet the cost if any claims were there. So essentially, the company paid 4.29 crores each year. Any variable additional premium that was required to be paid above this number, it was borne equally by the company and employees. So employees, there used to be a deduction from the salary. This deduction, not refundable, not something that gets paid out at the time of superannuation, nothing. It's a one-time thing. There's a deduction and that's about it. On the death of an employee, claim is lodged with the insurance company, and like I said, the payment is made to the nominee dependent of the deceased employee. So company's liability is essentially the two parts of it: the 4.29 crores, which is paid out as the premium, and any additional premium, 50% of it is borne by the company. Now, what has changed in 22-23 is really that the company decided to start off a trust to manage this entire plan. So essentially, again, the objective was exactly the same as before, to provide cash benefits to the dependent of the employee if the death occurs during the employees in service. The trust was to be managed by Board of Trustees. Company's contribution here again is 4.29 crores annually. There is also some fixed predetermined numbers that both employer and employee need to contribute on a monthly basis. It's different for different categories of employees. And if there is any additional contribution required, now during the year, if the trust is unable to meet all its liabilities, using up all the assets that they have, then any shortfall, the company needs to make additional contribution for that. This again is a very critical point to consider. And in terms of how the trust was set up, there was 15 crores of seed money, seed capital that was contributed by the company, which the trust needed to refund after a period in 5 equal installments. Now, contributions received by the trust were invested with LIC, and those funds were utilized anytime a claim was registered. Now, 2 points of views. The company's contention is that the definitions of defined contribution plan and defined benefit plan are very clear. And given the contours of this particular scheme, it doesn't really fit into either of those, because this is something that is paid out during the period that the employee is in service, but paid out to the next of kin. There is nothing that's happening on annuation or completion of employment. So it really doesn't fit into either of these definitions. And so no actuarial valuation needs to be done, and no disclosures under Ind AS 19 need to be provided in the financial statements. That's really the contention of the company. The auditor's perspective is that it doesn't really matter that at what point of time the amount is paid out, but this does fit into a defined benefit plan definition, and so provision as per Ind AS 19 needs to be made, and you need to follow all the requirements of Ind AS 19. That's really the contention of the auditor. So query, we come to, again, the question is very clear. What should the classification be? Is it a contribution plan or is it a benefit plan? And if it is a defined benefit plan, then what does it mean? Do I need to get an actuarial valuation done every year to ascertain what is the actuarial liability of the trust fund? I hope I've been able to summarize the question, and I will go back to Sarika on this one. If we can keep to time, Sarika, we have about 10 minutes for this one. Yeah, sorry for that. Yeah.
Yeah, no problem, no problem. Thanks again for summarizing, and you always do half of my job very beautifully again. So just coming back to the query, and I would like again to pick up a few points which will help us summarize the query, and that too I'll try and limit myself within next 10 minutes time or so. So the peculiar thing which Madhuri also mentioned, that why this query came up right now, because initially this fund, this scheme was managed by LIC independently as an insurer provider. But now the company, with effect from 22-23, has created a trust fund, and therefore the problem arises, and therefore there was a need to evaluate this new accounting. Very few points which I've picked up, which are very critical to respond. So though the contribution from the company and the employees are limited, but two important points I would like to highlight here, which somehow increases the liability of the company, which takes us from the defined benefit, defined contribution to defined benefit. So first of all, the company has contributed around 15 CR as a seed capital to provide the solvency and liquidity to the trust fund. So that means the company is going extra mile to take care of the functionality of the trust, to take care of the fund, so that there is no paucity of the funds which is available to the trust to be paid to the employee. That is one. Secondly, it categorically mentioned when there will be a shortfall, the company would make it good. So that clearly takes it from one side of the post-employment benefit, how we will just see. So the query really is the company hasn't considered it either as a defined benefit or defined contribution plan. For certain reasons, I'll just cite those. The company says defined benefit plans are post-employment benefit plans other than the defined contribution plan, and post-employment benefit plans are defined as employee benefit plans, which are other than termination benefit or short-term benefit, which are payable after the completion of the employment. The company contends that the benefits in terms of the insurance amount will be paid to the family members of the employees who dies during the service period. And if he dies after the service period, there will be no eligibility. Therefore, it is not a post-employment benefit given to the employee. Therefore, it is neither a defined benefit or defined contribution. Henceforth, he hasn't even done the actuarial valuation for any deficit in the fund asset, and also no disclosures are also done as per Ind AS 19. Further, company also reiterates the fact that based on the past pattern, it never happened that the company has to settle anything over and above that was required. Therefore, whatever is written in the contract that the company has the liability to make the shortfall good would not likely to occur, and therefore substance of the transaction is it is neither defined benefit or defined contribution. This is a very good and classic example of substance over form, which has been addressed by the committee. So the query, obviously we have to say whether it's a defined contribution or defined benefit. The guidance which has been covered by the committee are very simple, but the way they have beautifully roped in and concluded the answer is really commendable. So we know what post benefit employment benefits are. I'm not reading the definition. What are other long-term benefit are given to the employees? What are defined contribution plan? What are defined benefit plan? We all know. I'm not reiterating those guidance. Very important point what a committee makes is the entity may pay insurance premium to a fund as a post-employment benefit, and such plan shall be considered as defined contribution or defined benefit depending upon how the legal and the constructive obligation falls on the company. So this point they have added. And one very important point they have added, which will help us conclude the query. They have quoted two paragraphs, 155 and 156. Those paragraphs talks about the recognition and measurement of other long-term benefits. However, those two guidance refers us back to the recognition and measurement of defined benefit plans. So just keep this line in mind because this will help us to conclude the answer at a later stage. So the committee has addressed that since this amount has to be given post death of the company, this is a separate scheme, not as a part of the existing employment plan. Therefore, it does not meet the definition. I just repeat, it does not meet the definition of post-employment benefit or termination benefit as contended by the company as well. So they are in agreement. However, the twist here is the committee says it is in the nature of other long-term benefits. Committee further says that the distinction what is being made throughout the standard between defined contribution and defined plans is based on the economic substance to understand what is my restricted liability, what is not my restricted liability. Therefore, has to be read from a broader perspective. And since the company is also liable to make the shortfall good, therefore, what committee has opined, looking at those paragraph 155 and 156, it is not in true sense as a post-employment benefit plan. That is one. It is in the nature, I'm just repeating myself, it is in the nature of defined benefit plan because the company is taking care of the shortfall. However, looking at paragraph 55, 56, which talks about other long-term plans, other long-term benefits of the company, they refers it back to the accounting, which is done for defined benefit plans. So just to conclude what committee says, it is in the nature of other long-term benefits which are given to the company. However, in the nature of defined benefit plans, has to be accounted for as defined benefit plans, and therefore actuarial valuation is required to be done to do the present value calculations of the defined benefit plan and related service costs. That is the conclusion.
Thank you, Sarika. I guess the opinion has drawn our attention back to the residual category that we have, which most of us tend to kind of miss out, which is the other long-term benefits, I guess, under the standard.
But if I can just add 1 minute here, I think, while it was a very detailed discussion, and I know we've got to tick all the boxes as far as the literature is concerned and ensure technical compliance, I think first, even if you were to look at it from a very substantive perspective, okay, I am live. If I have promised my employees that I will pay you any, on death, I will pay something, I've got to accrue for it. Now, let's say if I had not opened the trust, I have carried adequate provision in my financial statements. I cannot avoid, or maybe I cannot get into under provisioning just by opening a trust. I have to any point of time make sure that the amount which either the trust, which is in a way, my executing body, or me directly is carrying is adequate to meet the obligation. It's as simple as that. So just because, let's say, if you feel, let's say I am a company, I believe my expected outgo is X. I have done 90% of X as contribution to the trust. I can't under provide. So and I think defined benefit, through the defined benefit classification, all that you're doing is you're recognizing that the company is still liable, right? amount contributed is not adequate. And then, of course, there are technicalities and complexities of actuarial assumptions. I'm not getting into that. But I think it's a very nice point that if you are responsible, then just by virtue of you opening a trust, which is not really taking away your liability, does not mean you can provide less.
Absolutely. Thank you. Thank you, Archana. And I think with that, we'll close out on today's discussion. We weren't able to take up the sixth one, but hopefully next time, the next panel will kind of deal with it. Back to you, folks. Thank you both for such a wonderful session. I think I had the greatest time moderating both of you and look forward to the next time we interact. Back to you, folks at the EAC committee.
Thank you, Madhuri ma'am. Thank you, all the participants, for joining today's webinar. We appreciate your time and engagement. We want to extend our gratitude to the speakers of the webinar, CA Archana Bhutani, CA Sarika Gusai, and CA Madhuri Shahpure, for steering today's webinar. The views expressed in the panel discussion were insightful and gave guidance on many relevant issues. The opinions discussed are quite relevant to almost all the entities. Although these are facts and case specific, they explain important principles of the standards. We believe that this deliberation at the panel discussion will be of immense help to the participants. We assure to give the benefits of EAC expertise in future as well. While signing off, I once again wish all the women participants a very happy International Women's Day and an auspicious Mahashivratri to everyone. Thank you, everyone.
Thank you.
Thank you.